very soon here.
Okay.
And we're live, everybody. What's going on? We're going to do a little bit of pre-show. I know it's not 7 o'clock just yet, but it's what's weird. It's been a while that Daniel and I have been on the same.
We never go on the same screen. Are we on screen right now?
Yeah. Let me turn you down just a bit here.
Yeah. Am I too loud?
Yeah. You may have to be a little bit more apart from the microphone.
How about right here?
You're good. So we're not officially getting started yet till another minute or so. Actually, hey Joel, could you give me or someone out in the door? Could you give me the remote control? We're gonna get the TV turned on.
So do you see the questions from there?
Yes, I can see the questions, and I'll obviously repeat.
All right. So you'll be the moderator.
Yeah.
And the contributor.
Yes, I'll also be contributing to some of the questions we got. So, by the way, appreciate all of you guys coming on board. I see quite a few of you jumping on right now. Let me go and switch the TV here.
Yeah. Let me see how many.
See how prepared we are. By the way.
I'm trying to get a look.
Yeah. There you go.
Oh wow, we have 21,000 people already online. There we go. Now I can see.
There we go. All right. I had dinner prepared, but I'm gonna have to skip that for now until we're done.
You don't want to eat and do this at the same time?
We could.
Yeah, why not? I'm sure people will care. Well, leave it in the comment section right now. Let's get some engagement going. If you are okay with Sam eating while we do this, please type in, I'm okay with Sam eating.
Yeah, so, hey, what's going on, guys? So I see a bunch of you guys. Miriam, welcome. Chanel, welcome. Paul, AZ, welcome. HELOC rates are dope. We'll talk about that if you guys want us to talk about that. Miriam says eat. I'll eat.
Yeah, well, is this a plan to have me not see that? Is there something I shouldn't be watching right now?
Yeah, there we go. So we can kind of see the chats coming in.
Yeah.
Go ahead and eat. Food will be here. So the important part is we got to get through the show. We got to get through the Q&A. You guys know what's going on right now, right? Daniel and I have been tracking this for the last few days. The impact of the coronavirus, COVID-19, and real estate, the home equity line of credit, accelerator banking strategy. You guys, a lot of you guys pay attention to that. Landlording, property management, investing in general. Daniel's going to do a lot of.
It's a lot. It's a lot of stuff. Everything under the sun is being affected.
Daniel's going to contribute a lot as far as macroeconomics.
The real estate part, yeah. And then you could do the banks and HELOCs.
United Vision Investment, Steve. Wow. Hey, what's going on? Steve Nomura is on board. What's going on, Steve Nomura?
Steve Nomura. Wow. Steve.
Hey, we're doing well. I hope you're doing well as well, Steve.
We miss you, Steve.
Absolutely.
Oh, I don't want to.
Yeah, we don't want to tangle the ropes here. So, guys, let's go ahead and fire off any questions. Let's start with this. We've been releasing videos for the last few days. Just kind of giving as much updates as possible. We were also watching conspiracy theories as well, which is kind of interesting.
Coronavirus.
So let's do a 30,000 feet overview of what's happening everywhere. Right now, let's recap on what's happening. We have to assess the information. Okay, so Daniel, what is happening? Let's go and talk about Federal Reserve rate. What happened last weekend?
All right. Well, I think a lot of people know already. Why do I sound so distant? So a lot of people already know that rates are dropping historically low. They announced what's known as QE5, which is quantitative easing, which is falling under the subcategory, as we call it, open market operations. And open market operations, for people that don't know, is one of three ways that the Federal Reserve increases what's known as the money supply. The money supply is the level of liquidity that a market or a general economy has. And there's three ways we do that. We lower and raise rates, interest rates, which is, by the way, when you read articles saying that the Federal Reserve have increased or lowered rates, that does not necessarily mean that your mortgage is not going to go up or down. The banks, the central banking system, lends money. They borrow money from the Federal Reserve at a certain percentage, just like how you borrow money from the central banking system. And the banks make money on that spread. So that's how a lot of times the banks make money. So we have the interest rate, and then we also have something that the banks and the media, right? Everybody loves the media that they don't talk about. It's called the reserve requirement. It's the level of liquidity a bank has to have in order for them to do business and borrow money from the Federal Reserve. So we have those two, and then we have open market operations. We talked about QE5, which, interestingly enough, going back to 2008, 2009, they have officially purchased $200 million worth of mortgage-backed securities on top of treasury notes. All right. So we have 700, correct me if I'm wrong, but 700 billion right now. And that number, I believe, has reached $1 trillion. It's about to reach, or has reached $1 trillion in terms of relief. So that's what's going on right now. Now, what does this necessarily mean? So we're seeing the stock market respond in very interesting ways. You know, like yesterday, a couple days ago, I forgot what day, I don't even know what day it is anymore. But yesterday or a couple days ago, the Dow, it went up. And then it went back up today, and then it's just kind of been going on this roller coaster ride. And you know, it's a lot of it is fear. So some people are buying the dip, which I think is why the market went up the last couple of days. And then, you know, a lot of people are being very cash friendly right now. So that's the overview.
So I got 2 or 3 questions that are the same right now.
Okay.
Is it a good time to buy a house?
Is it well for what? Are you talking about residential, or are you talking about is it for investment purposes? Is it for primary residence? Please clarify. But until then, I'll give you answers on both. And well, you know what? I don't want to be the one talking the whole time. So why don't you explain first? What does that mean on the banking side, and then I'll explain on the real estate.
Yeah, real quick, Joel, if you're on the computer right now, would you be sharing this, circulating this around different groups? If you go into Google Chrome, my Facebook account should already be there, so just circulate this. By the way, guys, if you're watching this, be sure to share this on your Facebook, Instagram, wherever you can. We'd love to have this conversation. Reach out to as many people as possible. But let's go and talk about the thing that Daniel talked about earlier is the Federal Reserve rate did drop over this weekend. The target rate now is at 0 to 0.25%, and there's still a large amount of public misconception about what's going on right now with the interest rate. This does not mean that your mortgage rate right now, if you go and get a refinance, it doesn't translate necessarily to the refinance rate that you'll pay. I see a lot of people who are going out and saying
they can't hear you.
Okay, hold on one sec.
Yeah, turn yourself up.
All right, can you guys hear me now? That's better. Turn your mic volume up. Let me see if I could.
Yeah, Anthony said that's better.
Anthony says that's better. Let me try to get this up a little bit more. Can you guys hear me? We can hear you now. Okay, perfect. All right, I'm sorry about that. So by the way, we haven't done a live in a while, so as you guys can tell. So let me kind of take 10 steps back here. The Federal Reserve rate did drop this weekend to 0%. The target rate's at 0.25%. Now, there's a vast majority of public right now thinking that it's a great time to buy or refinance right now, which is buy or refinance, because new mortgage origination happening right now will give you whatever the interest rates reflected right now. But there's this misconception in the public right now that if you go and refinance or get a new mortgage right now, you'll get a much lower rate, which necessarily not true. The Federal Reserve rate has been lower, like Daniel said. That's the rate that banks will borrow. But for you guys, the consumers, they are increasing the marginal rate, which is the rate that the banks profit. That's what they charge you on top of the Federal Reserve rate. They're charging that more so that the rates are rather consistent. In fact, there's certain banks that actually are raising it more than before so that they can curb the onslaught of people refinancing right now. In fact, just before I got on live, I went on Google Trends, looking at keywords. The people are looking for more refinance loans right now than ever before the last 3 months. What does that mean? Well, there's still a large amount of people that are thinking that refinancing right now is a good opportunity, which in my opinion, it's not. You're still going to get the same rate, relatively the same. I know some of you guys may say, no, Sam, you can get a better rate. Vast majority of the banks right now are still offering the relatively same amount of rate before, because the marginal rate has gone up. All right, so with that being said, you guys who've been following me for a while, I'm not a big fan of refinancing in general. Because if you go and refinance your mortgage right now back into a 30-year fixed, what happens is that you'll reset your amortization clock. That's number one. But more importantly, this is where it gets really damaging to your financial, is you reset what's called the front-loaded interest zone. Vast majority of your monthly payment, if you go and refinance earlier on in your mortgage cycle, vast majority of your monthly payment is going towards the interest. So just to illustrate my point, about if you're at $1,000 a month, let's say, in your mortgage payment, about $800 of that is going to go towards the interest, and 200 of that is actually going to go towards the principal balance. So net, bottom line, is it a good time to go refinance right now? Not necessarily. I think it hasn't improved or hasn't gotten worse. It's sort of the same predicament. The thing has changed right now with the banks is that their processing time with the loan is significantly slower than ever before because of this misconception that's driving all these people to go get refinancing and mortgage. So just keep that in mind. When it comes to
So the original question was, should I buy a house right now?
Should you buy a house right now?
That was the original question. Yeah.
I think there's an angle there where you can buy a house. You can buy a rental property. I think we can still continue to buy rental property mainly because there's some angles where landlords that are in fear mode,
Well, I was kind of confused with the question, so I asked, well, what is it for? Is it for your primary residence or is it for an investment property? And there's pros and cons with both, right? There's pros and cons with everything, right? So Sam mentioned kind of on the off track that right now what's going on with the banks and the mortgage rates that doesn't necessarily affect, right? The federal interest rate doesn't necessarily affect the rates that you're going to get if you were to go to a bank, right? So I'm kind of looking at the comments. Let me see here. They were horrible today. No, it actually closed today. I'm looking at it right now. It's plus 188.27 points today. So it actually went up 0.95%. So it was not horrible today.
So those who are asking, so Henry Cole clarified saying home for primary residence.
So home for primary residence right now. So interestingly enough, in the real estate housing market, so every answer that I give to you guys is a culmination of the research that I do every single day for the sake of my job, which is a real estate syndicator. And then number two, just me speaking to my networks. I mean, I talk to people every day that it's in the real estate industry, whether they're a real estate attorney, a broker, a property manager, a lot of realtors actually. And a lot of them are still telling me that a majority of major cities and states, anything under 250, it's very hard to get. It's very, very hard to get. And why is that? Well, I relay everything to supply and demand. At the end of the day, business, money, finance, it all gets down to supply and demand. All right. So with supply and demand, you've got, number one, you got a lot of the older millennials in their late 20s and early 30s that are just now entering the housing market. I read an interesting statistic that it was about a month ago saying that the biggest crowd of millennials are buying homes right now. Like they're actively searching, like right now as we sit here and Sam is eating his Korean curry. Right now, the largest amount of millennial buyers are right now in the housing market, and they're looking for starter homes under $250,000. Matter of fact, the specific range that they're looking for is 175 to about 250, right? Because we all go on Zillow and Redfin, and you see like the price range and things like that. That's actually the most searched price range out of the millennial population. So number one, you've got a lot of demand. That demand is kind of surged again by low interest rates. It's also surged by timing issues, like I already mentioned with the millennials and where we are right now. And also the third aspect in terms of what boosts up demand is that single family rentals are more popular today than they were 3 to 5 years ago. I mean, if you look at right now, a lot of people are looking towards the single family rental housing market as kind of the cornerstone for the basis of the real estate investing industry as a whole. We've had about 5 years now where, apartment complex syndications were the thing, like they were like the trend, like back how 2012, the Cat Daddy dance was the most popular thing. Now, it's just single family housing rentals. That's what's popular right now. So is it, supply and demand says, is it a good time to buy a house right now? I would say no. You have a lot of single family houses that are kind of overinflated. And the way I deem, whether or not a house is a good investment is, well, what is the power of the liquidity that you're putting into that individual asset? And what is that liquidity going to do most likely for the next 2-3 years? When you're buying a house, you're most likely going to have to put some money down. Unless you're using like an FHA loan or using some special financing program where you only have to put 3-5% down. But either way, it is a very high investment because even if you're not putting a whole lot of money down, you're probably paying PMI, right? You're probably paying a mortgage with taxes and things like that. So at the end of the day, it is an investment. Now, in terms of how well that investment is going to do, based on what I see in the housing market right now, not so well. But don't let what I say stop you from buying a house for a bigger reason, right? Like if you got kids and you really need to find a bigger space, or you just got married and you're looking, you and your wife or I don't know who asked the question, so I'm going to say husband, wife or husband, are looking for your dream home. Well, don't let what I'm saying stop you. If you find a phenomenal opportunity and you find a good deal, you're more so likely going to get phenomenal financing rates today. Go for it. Don't let me stop you. But just from me and my number brain, that's kind of where I'm coming. I don't know. You seem to have thoughts.
Yeah. So with real estate, I mean, I think temporarily right now, the next few weeks until we got, we have this crazy quarantine thing going on right now. I can tell you, showings have been slowing down. People actually going and looking at houses have slowed down. And I can attest to that because Daniel and I are selling our personal residence. And 2 weeks ago, we had massive amount of showings. We had like 6 showings a day and then 5 showings a day. And we have a lot of people coming. They can't hear me again? Oh my goodness, what's going on? Let me see.
What's the deal, man?
I don't know. Okay, can you guys hear me now?
Good.
Yeah, can you? I don't know what's going on, but check 1 2 check. Sure. How about now? Is it working? Intermittent sound. Let me see. Check 1 2 check. Check.
His mic is off. So is it that you can't hear him as loud, or you just can't hear him at all?
I mean, I can hear myself from it comes and goes.
Yeah.
Oh, better. Yeah, I don't know what's happening with our. It might be because putting in a lot of.
So they're all saying that they can hear you, but just not as loud.
Hold on, let's see. Not as loud, barely.
Yeah.
Okay, hold on. Check 1 2 check 1 2. Can you guys hear me now? Soft, not clear.
Well, I think it's pretty clear who God wants to talk. Between two of us.
Hold on. Let me make sure.
Do you want?
You know what? I know what's wrong. I know what's going on. Go ahead and do.
All right. So I saw a question that says, what are the cons of buying an investment property? And I also said, I also saw another question that says, should you buy an investment property right now? So I'll just kind of answer both in the same breath while Sam figures out his mic, because our mother always says, Daniel, you need to let Sam talk. So.
Hold on. So can you guys hear him or?
So they said it's better now.
Yeah, but better now to who? Because like he's clear. I'm not. Okay.
Yeah, Ricky's saying that I'm clear, which is obvious. So let me answer those questions while you figure that out.
Check. Okay, I guess not.
So should you buy an investment property right now? So if it's off market, yes. And right now, so we put together a phenomenal recession proofing business training. So I spent the last couple of days really just grinding it out. It's about a 2-hour recording. So if you guys want to check that out, feel free. If you want to, I don't know if you want to put it in the comment section or you want to find somewhere, but check that out. But I actually talk exactly about what you guys just asked. Right now is a phenomenal time to buy an investment property right now. So yes and no, right? So yes, if number one, you've got to secure long-term financing, because if you look at what typically investment properties tend to do, now if you're looking to buy one or two single-family houses, and you're looking to kind of just have a low-key operation, then that's really not that big of a deal. Usually huge problems or potential obstacles don't occur really if you're under the radar. But what I'm more so thinking of is history lessons in terms of what happened in the last, not even just with 08, but what happened with a lot of different market downturns, right? We saw one from 2000 to 2003. We saw one from 08 to about 2012, 2013. And before that, it was, the early 90s and then the late. So there's a lot of different patterns that we see. And typically what the common issues that I see over and over again, and as I sit down with a lot of these investors who've been through all this, is if they buy an investment property and they buy it on market at inflated values, that's number one, and they go with traditional institutional financing, what really kind of causes them a lot of trouble is when that value tends to go below the balance of the note. So if you take out a mortgage or residential mortgage or any type of program where you're using it for investment purposes of acquiring a rental, you get that loan, the value all of a sudden drops. And I think you guys would all agree with me, all 64 of you, who only 3 of you put a thumbs up, but that's none of my business, whatever. But for a lot of you guys that are looking to buy real estate and investment properties, the issue that really comes is when the value of that housing market, of that house, of that asset goes below the balance of the note. And I think you guys would all agree with me when I say that probably in about 3 years, a value of a single family home or an apartment complex isn't going to be as high. It's just not, and if I was a betting man, I'd probably say about 80% chance that an investment property, whether that's an apartment complex or a 4-unit or a single family house, is not going to look as good. So I in my recession proofing in my recession proofing training, I instruct, hey, listen, if you're gonna get a buy and hold property right now, you make sure that, number one, it's off market, so you're not competing with other individuals. I think the last time I bought something from the MLS, it was a 24-unit apartment complex, and we competed with 15 other people bidding on that property. So it's interesting. So right now, if it's on market for investment purposes, you're going to go with a lot of issues, a lot of potential problems. But if you're going to go through a single family house and you're dealing with more of a Mr. and Mrs. Jones type owner, and you're really the only one talking to that individual, go for it, right? Go for it. But make sure you're educated. Make sure you set up good terms, and make sure if you're going to go with an institutional lender, whether that's hard money, whether that's an institution that says they're private money, but they're really not by definition, or you go with the bank, make sure you secure long-term financing. Please, and write this down, everyone, please avoid short-term balloons right now in the market. Because what happens is that if you were to, let's say you got a 3-year balloon, well, 3 years later, if you need to refinance or you need to get a new loan, what the banks are going to do is what's called a reassessment, right? Once you reassess the property, they most likely will see that the value is a lot lower than the note balance, and they're not going to look too favorably on that. So you may have an event where you have to cough up a pretty significant amount, or you may not be able to find another bank that can refinance you, potentially having you in a situation where you have to sell. All right, let's go to the other questions. So here's how we're going to do this. I'm going to switch.
All right, can you guys hear me now? I think you guys can hear me because I had to. So we have a very expensive studio setup that is getting choke pointed by like these little things. So they can hear me. Okay. For some reason I can't. The recession proof trick is not. Yeah. Yeah. Just the Joel. Okay. Can you hear me? Okay. So whenever Daniel's talking, I have to like manually switch over. So just about Daniel, before Daniel talks, I'd have to switch the cable and stuff like that. For next time, we're going to do this better because you're not on right now. So I gotta turn you over. Hold on. Now you're on.
Now I'm on. Oh, so you guys didn't even hear what I said. I said some pretty crazy things. But oh well,
Yeah, this is gonna be a pain in the butt, but we're gonna get through this, folks. We're gonna get through this. So I saw a question earlier that says, but HELOCs, banks are not taking new applications for HELOCs. So not all banks. There are majority. I'll say this, and this isn't backed by any stats or research. I would say about 80% of the banks right now are still functioning normal as if nothing's happening. The only downside is that processing time is much slower. There are some banks that can't take on the sheer volume of people right now, the inquiries that people are getting right now. So that's what's causing us to slow down. Remember how we talked about, and I hope you guys heard me before because I hope our mic issue wasn't happening before. But the general perception that's going on right now with people, because the interest rates dropped to 0% to the Federal Reserve interest rate dropped to 0% to 0.25%. The general public perception right now is people think, oh my gosh, the interest rates dropped. I'm going to go and refinance and save money. Number one, the interest rates as far as what you will pay as consumers did not change much. And this is caused by the banks raising the marginal interest rate which is the interest rate that they charge you, the consumer. The federal fund rate is what the banks get charged from the Federal Reserve, the central banking system, and they'll lend it back to you with the marginal rate, right? Arbitrage is essentially. So they'll right now they're still going to charge you anywhere between 3 to 5%. I had a conversation this morning with a gentleman who said, "Oh, I'm gonna go refinance my mortgage to 1.5%." It doesn't work that way. The mortgage rates right now average, you're still going to see the 3 to 5 range that we've seen before in the last few months. So just because the Federal Reserve dropped the interest rate does not necessarily translate to the refinance rates, the mortgage rates, etc.
Let me chime in. Multifamily, right? Yeah. So let me get to that question here in a second, but I actually just want to chime in a little bit on what Sam just said, because Sam kind of explained how monetary policy works. Now, here's a really good rule of thumb for you guys to know. So I call it the rule of two. So typically speaking, I spoke to a lender about this, who actually is a pretty high up individual in a bank called Wintrust, I think, here in Illinois, which is a pretty big bank here in the Midwest. But it's called the rule of two. So whatever the federal interest rate lending rate is, you add 2, and that's typically what the banks will charge. Now, in certain economic times where the Federal Reserve is looking to pump liquidity into the central banking system, you will see that margin widen very significantly. And what are the telltale signs that a central banking system is looking to increase liquidity? I'm sorry, the Federal Reserve is looking to increase liquidity in the CBS, the central banking system, is what we call the repo market. So we've seen this starting in September of last year. And I remember it because my wedding date is October 11th, and they started on October 13th all the way to November 3rd. Every single day they were pumping money, and I believe they pumped a total of $540 billion in the span of 2 weeks into what's known as the repo market. Now, the repo market is pretty much, long story short, it's pretty much funding banking operations. So the central banking system, which are good friends at like Bank of America, Morgan Stanley, Goldman Sachs, those are the guys who pretty much operate a lot of what goes on in the U.S. economy. So whenever you see the Federal Reserve funding the repo market, because they just announced another $1.5 trillion of a loan to the repo market, which is funding, again, the central banking system's day-to-day operations, that's when you know that is a telltale sign that they're looking to increase liquidity in the central banking system. So that right there tells you that the margin in terms of what they're going to charge between the lending reserve, right, the federal lending rate, and what they're going to charge us, the consumers, in the form of, oh, excuse me, sorry, I had fried chicken for dinner. In terms of what they're going to charge us for like commercial loans, for residential mortgages, for even many times HELOCs, it tends to widen the margin a little bit, right? So that rule of 2 all of a sudden becomes, a little bit more like 3/4. I have yet to see in the history of the U.S. economy where it's extended more than a 5 or 4 point margin in terms of what the traditional residential 30-year mortgage rate is and the Federal Reserve lending rate. So I've yet to see that level of craziness. Now let's get back to the question somebody asked in regards to, oh, look at that. Now let's address the question in terms of what do I think about funding for multifamily properties? So multifamily properties, well, let's clear the verbiage a little bit, right? So I want to be clear with the verbiage, and I love what we got going. This is crazy. This is like the Howard Stern show. Joel's got the whiteboard writing messages, and Joel's writing "I love you." I love you too, Joel. Right? So let's talk about that. Let's talk about the verbiage. So multifamily, I want to be clear, is literally multi-units, but it's less than 5 units. So we've got residential, which is 1 to 4, and then we got commercial, 5 units and up. Single family refers to 1 unit, right? That's just literally a house. Multifamily refers to 2, 3, and 4. And then commercial, which is the apartment complexes, are typically 5 and above. Now, I'm guessing that your question alludes to, hey, what about commercial mortgages? What about, investments 5 units and up? What do you think about funding for those? Well, let me spit off some facts that have been very true for not only 2019, but also the last 3 to 5 years. So there's a lot of different online influencers that are telling people to buy very high unit count assets. I'm not going to name any names, but yeah, I'm not gonna name any names, right? But
Let them know we're pausing.
hey, we're gonna pause. All right. Oh,
I'm sorry about that, guys.
demons be gone.
I apologize.
Demons be gone.
We're switching over to a new mixer system, so I hope this. Can you guys hear me now? I think
Power
so.
of Christ compels you. All right. Are we back on? Can you guys hear me? Oh, both can hear. Ooh, Sam Kwok with the audio skills.
All right. Oh,
All right,
gosh.
so let
All right,
me go back. Okay, so multifamily, so five units. So let me spit out some facts, right? So a lot of people are going after multifamily properties now more than ever, right? I mean, if you go to markets such as like Phoenix, Arizona, or Arizona in general, and then Texas, Tennessee, North Carolina, every single one of those states have been overtaken by investors, real estate investors looking to put money into apartment complex financing, right? Acquisition of apartment complexes. Fun fact, the average amount of capital that is dedicated to multifamily / apartment complex assets typically on a year-to-year basis is usually around 19.1%. Now, in the year of 2019 alone, and also culmination of 2018, 2017, but this piece of data was recorded in 2019. That number of 19.1% has skyrocketed to 26.3%. Now, you're talking about a 7% jump. That is huge because you're talking about the overall capital market for real estate investors as a whole, meaning that this is every single penny and dollar that's dedicated towards investing in real estate. There's a 7% drop in terms of the market share of apartment complex financing buildings. And on top of that, up until 2019, because 2019 was really the year where a lot of foreign buyers started pulling out. But from like, I believe 2012 to 2019, there was just a flurry of outside foreign investors looking to invest into the U.S. multifamily industry. There was a flurry of that. Like Sam Zell talked about it, Barry Sternlicht talked about it, Jonathan Gray talked about it. I mean, all of these guys, Ken McElroy talked about it. All these, massive guys who own tens of thousands of units are all talking about this, and we've seen them pull out. But at the same time, the funding for multifamily real estate investing, to say all that, has relatively been extremely competitive. Sam and I, along with a former partner of ours, looked at a 24-unit building about 2 years ago. Was just in the worst shape, right? I mean, do you remember this? There was a car where all the windows were broken in.
The 24 unit?
Yeah, it was like right across the street from middle school, but it literally looked like it belonged in a war zone. Like there was a car with all the windows were broken in, all the tires were stolen, and there were cinder blocks on it. The parking lot was filled with garbage and let's call them see-through balloons.
Well,
right?
they were calling this a rehab property.
They were calling this a rehab
Right.
property, and it was just awful, right? Like you couldn't even tell what color the walls were because of how dingy they were. Same thing with the carpet. The cabinets were falling off, and based on the market cap rate, we made a generous offer of $700,000. That was a generous offer. The market cap rate at the time, in terms of what was normal and competitive, was around 7.5%, I believe. My partner and I talked about that at the time. And we made an offer that was for like 6.8, 6.9. So it was a great offer. We got laughed at out of the building. Remember that? We got laughed at out of the building. The guy's like, I don't want to talk to you guys anymore. And then I get a call 2 weeks later that apartment complex got sold for $1.4 million out of a group in California. So again, what do I think about that? I still think it's relatively high. I still think opportunistic times are to come, right? So let's go on to the next question. Tenant default fear.
I asked this yesterday on Facebook, but I'll reiterate
go ahead,
again.
Sam.
Now that I have power to speak and be heard,
There you go. And you're finished. Well, you're almost done.
I'm almost finished with the food. The food is the worst. The last thing I'm worried about. I'm worried about. I'm more concerned about making sure that this goes well. So let's talk about tenant fears. I know a lot of you guys are talking about this. As far as will tenants pay rent, and what if they don't, and we'll have to address that. So number one, the first thing I would do is at very least, communicate. And what I mean by communicate is start going out. By the way, tell me if I sound good, because good Lord, technology today, right? Number one, communicate. Call up your tenants. If you have rental properties right now, even one single rental property, call up your tenant, send them a text message if they're not a caller, and ask them, how are you guys doing? Right? Call your tenants, be like, hey, you guys doing okay? Are your family, is your family doing okay? Are you working right now? Do you have income coming in? Ask your tenants if they're doing well. Not, hey, are you going to pay rent? Right? Tenants are people too. Tenants are humans just like us that deserve respect, and they want to be appreciated. So call up your tenants and say, hey, are you guys doing okay? You guys doing fine? First establish the communication, gather as much information and intel as possible. Now, when I was in the military, and I'll kind of bridge this analogy, the number one reason why a mission fails in a military scenario is lack of communication. So if there's no communication from the headquarters to the soldiers in the field, the likelihood for that mission to go well is very low. So you have to communicate with your people. So communicate with your tenants, communicate with your property manager. If you have a property manager, communicate with your vendors. If you're worried about the fact that your tenants aren't gonna pay rent, call up your mortgage companies ahead of time. Okay, call up your lender and say, hey, there might be a chance that my tenant may not pay rent. Could we possibly talk about deferring 2 or 3 months of the mortgage payment and lump the principal balance back into the back end? And then, obviously, so that you guys don't lose money on this. I think all the banks right now are at least prepared to have that conversation. Okay, it's not something out of the blue, right? Banks at least know what's going on. So number one thing I would do if you guys are a landlord, start calling up your tenants, call up your mortgage companies, and figure out what's going on. Another thing you can do if you guys want to go overboard and above the board is what I'm trying to say, is go and pass out water to your tenants. Do some grocery deliveries for your tenants. This is a great opportunity to establish some powerful, real good relationship with your tenants. It's an opportunity. Okay. I know a lot of you guys are fear driven. We're like, oh my gosh, my tenants aren't going to pay rent. How am I going to take care of myself? Yada, yada, yada. A true entrepreneur is always asking the question, how can I create an opportunity where I can provide value to all my people as much as possible? Okay. So that's number one. Okay. And from there, you'll actually get enough information to start making smart decisions. Number two, don't panic and don't go off to start making emotional decisions. Because the moment that you start inserting emotion into your decision-making matrix, then that's when you damage yourself, damage your tenants, and damage your company. So that's the last thing we want.
Right. So real quick, well, are you finished? Because that was great.
No, let's go ahead and have you address this.
So there's a question that that got skipped back.
Oh, okay.
Way back.
And then we'll address HELOCs, because I saw a couple questions about it.
Yeah,
I know Paul was asking about HELOCs.
I'm gonna answer 3 questions in a row. We'll kind of just do speed round just so we get everybody's. But there was a question that got skipped back. I want to make sure we address it. So the question was: there's a new construction townhome flip. So somebody's doing a fix and flip on a townhome. It's new construction, and it's going on the market. And the individual pretty much wants to know: should I be worried? Is there enough purchase power for you to do that? So a couple ways. Right now, at this moment, you should be worried. I hate to. Sorry, I like to keep it realistic, but yes, because a lot of people, unfortunately, because of the what's going on right now with the pandemic, a lot of things are slowing down. Right. So I know approval processes for financing is slowing down.
Yeah.
I know even approvals for, just with title companies, a lot of things are slowing down.
Which means longer holding cost, bigger holding cost.
Yes, for you, since you're fix and flipping a townhome.
Right.
Yes. That could potentially, from what I hear, be 30, 60, and some states even 90 days. Now, having said that, once a lot of this stuff blows over, should you be worried? No, I don't think you should be worried at all. If there is a recession coming, I think it's probably going to be maybe about 8 months later. Now, again, a quick little reminder: we did put together a recession-proofing business training. That again, Joel, I think you put the link, right? Or you can email us at info.
I'll give you the link. It's recessionprotected.com.
There you go.
So that's it, recessionproofit.com. And we're not, by the way, guys, don't misconstrue this live call as some sort of a sales gimmick or anything like that. That's the last thing we'll mention. We just prepare this thing together.
Right.
If you guys want it, great. If not,
Right, exactly.
I'm happy. So
Right, we do
yeah,
well.
let's go and
All right.
address
So
some
next
questions
question
here.
is: do you foresee landlords, owners of specifically 8+ unit buildings who have been in the game 10+ years, deciding to get out now from the Corona scare? How do you encourage them to? So are you pretty much asking me, James, how do you encourage people to be fearful to sell them? That's a smart idea, man. Use fear to get them to sell you their property. So a couple things. I don't personally think that they're quote unquote scared. If they're individuals who have owned properties for a very long time, typically if you see people who've owned it for like 10+ years, it's usually not like 10 years on the dot. It's usually more so like 15, 20, 30 years. And these are guys who have seen it all. A lot of them won't be scared. And I'll tell you why, right? I'll tell you the biggest reason. Because back in 2008, 2009, what's known as the Great Recession, I mean, I think when we think of hard economic times, that's the first thing that pops into a lot of our minds, right? All 82 of us, right? 86 if you include the people in the studio. So all 86 of us. One of the very few assets that didn't tank was the apartment complex industry. If anything, during the recession, it got better because a lot of individuals who lived in houses, I think the foreclosure rate, I mean, I was speaking with a gentleman from Wells Fargo, and he literally told me that they had to stop putting out signs. They had to stop putting out foreclosure signs because it was going to scare the American public, right? And that's a problem, right? Because you've got all these millionaires and billionaires, right? No, I'm kidding. Right, Colonel Sanders,
Bernie here,
right? So literally, the guys like we had to stop putting out signs, foreclosure signs. It was going to scare the American public. 1/3. Well, guess what? Those 1/3 people did. They went to apartments. They started renting instead. And that actually, if you actually look in 2008, 2009, you actually the rental pool in terms of people that wanted to rent apartments got bigger. Every single landlord that I've spoken to who have invested for 15+ years, 20+ years, I mean, you're talking about, these are my peers, right? And you're talking about guys with, 500 units, 3,000 units, right? I got a friend who had 16,000 units. Every single one of them says, yep, all the other investments that I had, like condos, single families, they are all in shambles. The only thing that I didn't lose my butt on was the apartments. If anything, apartments surged. So if you're talking about landlords who have owned these buildings for 10+ years, for them, they don't have fear because in their mind, because we're talking about human psychology when we're bringing up the words such as fear, they most likely will not be fearful, right? Let's go to the HELOC stuff because I don't want that staying on the pan too long.
And then we got a couple more questions. And Joel, just so you know, we do see the questions coming in from our
actually
laptop.
write it. Actually helps. That helps me out a lot.
Okay, yeah, right for Daniel, Joel, and Ricky over there, guys. Ladies and gentlemen, a big round of applause. They're still here in the office, helping us out with the live. Anyways, let's talk about the HELOC. So I guess where do we start, right? I saw a question earlier from Paul.
Well, somebody asked, can you still use the HELOC strategy?
Oh yeah. So should we continue doing this HELOC strategy? How much time do you normally have before they lock it down? How will we know? So let me tell you guys this right now, and let's address this first, and then we'll start circling back around. The banks right now are not shutting down, freezing, or terminating, suspending, whatever the word you guys want to use. They're not doing any of that to the HELOCs right now. Now, are there some exposed dangers? Are we seeing limited cracks? Not entirely. I think if things get worse and worse and worse to the point where, I mean, we're going to have a riot, we're going to see a massive amount of civil unrest, maybe, possibly. But they usually, and I've been reading Regulation Z, which is the Truth in Lending Act lately, just trying to understand the process of how banks would do this, is they have to have some cause in related to not only the economy, but also a cause related to you. Meaning, if the banks feel like you lost a job or you don't have the capacity and the ability to pay back, then they can go and start, shutting down or at least lowering the limit amount on your HELOC. Now, even freezing, guys, in case of a freezing, what they'll end up doing is they'll pretty much say, hey, whatever balance you have right now, that's the new limit. So let's say you start off with a $100,000 HELOC limit, and unfortunately, the banks determine that they just don't have that confidence in you anymore. They can say, well, because your balance is at $20,000, congratulations. Now your limit is $20,000. Now you're maxed out on your HELOC. Doesn't mean that they may terminate the whole thing together. Worst comes to worst, the last thing they'll do, they'll try to get you to do is call the note, which means that they'll try to get you to pay the entire amount altogether. That's the worst case scenario. But right now, the federal government is precisely targeting that right now to try to provide relief in that, is the foreclosure aspects of that. So bottom line, do I think the HELOC accounts are being frozen or terminated? No, I think we're far from that. I don't think this is going to be as bad as 08. We'll keep an eye out on the mortgage default rate and how that all is going to play out.
It's dropping.
Rate, right? The default rate's dropping.
It's already dropping. I looked at it.
You mean it's going up or dropping?
Yeah, the default rate is going up. I'm sorry. So
Okay.
yes, it's going up.
Okay.
Slowly.
So are we double digits?
No.
Okay, so not a whole
That's
lot.
a lot. Double digits is crazy.
Oh, I know. That's
Yeah.
what I was asking specifically, because when we get to the double digit, that's when banks get scared and
Yeah.
they'll
Yeah.
start to
Do
panic.
you want to do another HELOC question? Well, there was another one I think I didn't.
Well, so to address Paul's question, going back, you can still do the strategy. In fact, now is the time to do it. Now is the time to start dropping those mortgage balances below 70% loan to value. And there's no this isn't like some hard rule. This is something that I made up. So there we go. The reason why I say 70% loan to value is in the Great Recession, 2008, the average value drop was 30%. So the reason why I'm recommending, or as an opinion, dropping your mortgage balance below 70% of loan to value is because if we see another repeat of 2008, you won't be underwater, or at least to the point where you're gonna be at a hard line where banks may look at you and like, it's not that bad. So should you be doing the strategy? Yes, absolutely. Do it right now. I would recommend that you go even more aggressive, try to get that mortgage balance down as much as possible. Because if you have high mortgage balance, and all of a sudden your home value drops, if it happens, I don't think it's gonna happen right away. If it does happen, you won't be underwater. Now, if you have FHA, VA loan, you may have some federal backed protection. I don't know. This is something that I got to research on, so I don't have the answers for that. So I'll provide some more answers and updates on that. But that's pretty much all I got for the HELOC strategy.
Well, let's address two questions there that was written on the whiteboard. So Mike Cunningham asked, "Do you see residential value dropping like 2008?"
Which actually ties with what I just talked about.
Yeah, it does.
Yeah.
Yes. Yeah, I do see it. I don't think it's gonna be that big of a drop because like 2008, 2009 was mainly fueled by poor ratings, right? I mean, we all seen the movie The Big Short. A lot of it was mortgage-backed securities that got exchanged through the note industry over and over again until it kind of just bamboozled and fell. So that was center stage in 2008. I don't think it's going to be as center stage in this one. Matter of fact, I think it's going to be more commercial than it is residential. Just me personally, right? So question number one, yes, but not as much as 2008. Number two, do you see lenders tightening up because of liquidity issues? Asked by Brian Singman. So Brian, thank you for the question. Really good question, actually. Do you see lenders tightening up? Yeah, I think so. I think both of us are actually in agreement that when you have kind of recessionary times coming, and by the way, guys, let me clear this up. A recession is nothing more than a country's GDP going on a downward trend for two quarters or more, which is 6 months, right? It doesn't mean that it's Armageddon, right? That's not what it means. It's natural. It happens typically actually every 9 to 12 years. There's typically a downturn, sometimes even closer than that, right? In terms of the space between. So don't be afraid of that, of the R word, right? But do you see lenders tying up because of liquidity? Yes, 100%. I think they're already making moves right now to increase liquidity in the banking industry. And I wouldn't be surprised. And what's amazing to me right now is that they've utilized all their weapons they've already can. They've already got rates down to zero. They've already put $700 billion plus. They put in $540 billion in the repo market. They put another $1.5 trillion. They're talking about the Federal Reserve balance sheet going to $5 billion and beyond. They've already done so much they can to pretty much relieve the public. Because at the end of the day, bad economic times come. not because of what actually happens, but because of more of fear,
Yeah.
right? And a lot of that has to do with the media. So they've already done so much. So in my opinion, it can only get tighter. Maybe for the next 3 to 6 months, they're going to be very loose because of where we are in terms of a pandemic. But after that,
Mhm.
I don't see any.
Yeah.
I don't see anything that could be done.
Let me address Angel's question right now.
Yeah.
So Angel, and we got like ton of questions above. Is it Alum? Ro's got a ton of questions. We'll try to address them all. We got like 10 more minutes left. So and we'll try to extend it a little bit because we went on at the time here. But Angel is asking, do you recommend staying liquid or paying down the mortgage? Well, Angel, with our strategy, you get to do both, right? You actually become liquid as you pay down the mortgage, because with the home equity line of credit, you're opening up more of that of the equity that you can tap into. And I might be addressing more so with an all-in-one loan or a first lien position HELOC. So yeah, by paying down the mortgage with our strategy, you are actually being liquid. This is why using our strategy is a great recession-proofing tool. It actually shields you from income loss. It also shields you from a potential foreclosure or freezing or shutting down of a HELOC. So
yeah, and also in my opinion, like if you're looking to do investing during the recession, which everybody wants to do because they
Right.
want to be opportunistic, the number one thing I tell people to do to get ready for a recession, not only to play defense, but to play offense, is you got to pay off your debt, right? Pay off that debt as fast as you can, right? This is why, again, Sam and I represent two different coins of what the Kwok brothers offer, right? Sam does a lot of expertise on the HELOC strategy and paying off your debt, and even a lot of personal finance, right? I'll throw that one at you. And I represent a lot of the real estate and the market information. There's a specific reason why we do this, and we have the relationship that we have, and we specialize in what we specialize in, is because in order for you to play offense during the recession, you got to play defense when it's not.
Yeah.
Right?
So real quick, before we address some more questions, just as a little reminder, be sure to like this video because it does help us a lot with our YouTube algorithm. We would love to see this video live being featured on the front page of the YouTube. It's a long shot, but let's make that happen. Be sure to subscribe to our channel as well. We're going to provide another live update pretty soon here. I can see the likes going up. Thank you so much, guys. Be sure to subscribe. We're going to do some more lives very, very soon as new developments come into play. So stay in touch, stay in the loop by subscribing as well as liking this video. So let's go ahead and get some more questions answered. Kamir, appreciate you. Hey, you're welcome, guys. James Conley, what off-market opportunities would you suggest targeting right now, and best suggested to make contact?
So James, I'm guessing you're referring to real estate opportunities, acquiring properties off market. So I'll address that real quick. So what's the best off market? So it's not, for me, it's not a matter of what's the best strategy to find the off market properties as much as what are the strategies that you should even be implementing? What properties should you even be targeting right now? So it's tough because, right now everybody and their brother is interested in real estate. I'm going to blame the interracial couple on HGTV on that one because they made real estate really popular. But in my opinion, I think some of the best strategies and the best real estate exit strategies for you to do during recessionary times, number one, I think, is short sales. The reason why I say short sales, and because short sales are right there, it's like the foreclosure's cousin, right? It's like the cousin that you look more as like a brother. But the reason being is because typically during recessionary times, when lending and money does tighten and the banking industry does try and reliquify, a lot of times that's when the short sale opportunities skyrocket. And whenever you see mortgage default rates go up, like we did in 2008, 2009, the opportunities for short sales as a real estate investor is phenomenal. It is really good.
I would also add subject to in there too.
So, yeah,
because you can take on, well, here's my angle on that. You can go and approach someone who might be motivated in terms of, I mean, they've been getting notice defaults, right? They're getting those letters from the bank and they're looking at this. I'm like, man, I really want to sell or I want to get out. Subject to is a great option where you can help them catch up the mortgage payments.
So the only thing I would say against that, and of course, this is what brothers do, right? We fight and we debate.
We argue a lot.
We talk about, hey, who could beat each other up? Right, it's me. But anyways, it's in terms of the answer, right? In terms of the answer, yeah, I think subject to is a good strategy because, of course, the answer to every single real estate question is it depends, right? So it does depend. If you have to pay a high premium because you're looking at somebody who's owned this mortgage for a very long time and they have a very strong equity position, they might not be able to let that go as much. And a short sale strategy is actually a little bit more of an emotional strategy in terms of your interaction with the seller. You have to have a certain level of emotional intelligence for you to pull that off. And you do have to have, number one, a phenomenal relationship with the bank and also a good relationship with the real estate attorney, which is why, again, I press so hard as pay off the debt and get in good graces with the bank.
Right.
Because if you get in good graces with the banks, a short sale is going to be very easy. It's going to be relatively easy, and you're going to be able to find phenomenal margins.
Yeah.
So I say that a short sale is, in general, typically an off-market property because, and I don't care what a lot of people say, but a realtor is not going to have that much of an effect on a short sale because it is predominantly what happens between you as the investor and the buyer of the note, the acquisitioner, and the bank, which is the lendee and the holder. The realtor or broker is really kind of just outside of that, right? They're like a sub-character.
Back in 2010 through 13, most banks actually required you be represented by a broker.
Right, 100%. Right. So in many ways, they're your representative, like it is with any other real estate investing strategy, quote unquote. But if you're looking for the opportunities, necessarily speaking, I would take a good look at short sales and foreclosures. I would take a very good look at if you're looking to do something now, because do I think now is a great time for short sales? No. I think it will be in about a year and 2 years, 100%. But if you're looking to do something now, I'd highly recommend finding something that's not in the MLS, that's not in Zillow, and acquire it owner financing.
Mm-hmm.
That was 100% what I would have you do right now.
Yeah.
Next question.
Yeah. We got who? Beasley?
B Slade. B Slade.
Oh, B Slade. Hey, what's going on? So, do you think that? So, this is a question for Daniel. Do you think there will be additional government action to help stimulate the economy? How may it be beneficial to real estate investors? Man, this is tough because Daniel just said we are using all of our weapons.
Yeah. Well, so the Federal Reserve has used all their weapons, not necessarily the municipal government. So now we talked pretty much all this time about monetary policy, right? Yeah. But now, B Slade, your question's actually referring more to fiscal policy. So fiscal policy is when government is going to use their municipal powers, primarily taxes, to pretty much affect real estate investors. I think the first thing that comes to mind is that there's an article that put out about Trump giving stimulus to the American people.
Yeah, $1,000 a month, $1,000 check,
$1,000 check, right? So throw it back to Andrew Yang.
Yeah, right.
So how does that help real estate investors? Well, number one, it ensures if there is a government stimulus, and I don't know if it got signed. I think I read an article saying that it did.
Is this part of the Stafford Act? I think I got to do more research. I haven't followed that. Yeah, precisely, but
I'm not sure.
It could be part of the Stafford Act.
Right. Shout out to the Q group, right? That's what we've been talking about today.
Right? The conspiracy theories.
Theories, right? So if you're talking about that stimulus, that technically is fiscal policy because it's government action being taken to pretty much affect the money supply in the overall market. So obviously, if you're going to give the American people $1,000, well, it actually does help us as landlords because now you're giving your tenants enough ammo for them to pay rent. Now you're talking about also taxes, to which I can't answer that question for you. I don't know if the government is going to use emergency powers to cut taxes or give tax credits to landlords. Yeah, I know that's something that's been talked about. But
are you talking about property taxes or?
Yeah, so I mean, I don't know if they're going to give tax credits to landlords for property tax or perhaps even stimulate depreciation and add a new rule. I'm not sure. So do I see governments acting on behalf to stimulate the economy? And how does that affect us as real estate investors? Typically, fiscal policy isn't as predominant as monetary policy. So I think we just kind of we're going to have to see. I think we're going to have to see how things play out. And of course, that in turn affects us, how that affects real estate investors.
Absolutely. All right. So
what was the second?
Yeah, we got Ro. Ro's got several here, so we'll try to kind of package it all in one. He says, "Hey man, I'm looking to close on a sorry, something happened here. Oh, close tomorrow on a rental income property. My property costs $228,000. Locked my loan at 3.5% closing. 3.5% closing costs came. Okay, so at loan at 3.5%. Closing costs came about $10,000. It is a townhouse, 3-bedroom, 2-bath. The home needs minor repairs. However, should I extend this deal until employment rates release for March for the first week or April? Should I wait and find another opportunity in the next upcoming months, or should I just go for it and rent it out ASAP? Well, the first issue is if it's closing tomorrow, if you put in any money in escrow, like an earnest money deposit, will say goodbye to your earnest money deposit unless they're willing to give back to you. I know Daniel's reading the whole thing. I mean, it's kind of a bad faith to back out of a deal now before closing, especially if you are using a purchase instrument, like a purchase contract, and if seller signed it and you signed it, it's fully executed. So I don't know. It might be bad faith to walk away from that if tomorrow is closing for you. What are your thoughts, Daniel?
So I would go for it. I would still go with it. And you said the home needs minor repairs. I think that's a tremendous opportunity, actually, because, well, what happens when you do repairs, especially on a townhome? Because for some reason, repairs affect townhomes more than it does a single family house, just because there's less attributes that make that is able to have the value be higher. But those minor repairs increases the value of the home. That increase in terms of the difference of how it increases, that's positive equity for you. Which that positive equity works very much in your favor, especially when we're going towards recessionary times.
Yeah.
So I still say go for it. What was this? There was like a second part of the.
It's just the should I wait or find another opportunity.
No, I still think you should go for
Yeah.
it. Jalen asked, what up, Jalen? Jalen asked, are credit default swaps still happening? As of May of 2019, yes. Morgan Stanley and Goldman Sachs started trading on the market. What is they call it something else, but it's like
trench something.
I know what you're meaning.
Yeah, it's trench swap or something like that. They call it different.
But yes, they call it something different.
Yeah.
And I actually think they started doing it even before.
It's called bespoke trench
opportunity.
Yeah,
right?
that's
like
what
BSO, right? Or something like that. BTS.
What an interesting name.
Right.
Yeah.
But whatever it is, I know they started even doing that before May of 2019, but I know it got predominant in May 2019. So Jalen, to answer your question, yes, it's still happening. Another question was vacation rentals. Somebody asked a question like 20 minutes ago about
vacation rental. Vacation rental. I think the question was vacation rental for themselves. I read it and I just kind of. If it's okay, so if it's a vacation rental for yourself, I think it's number one. It's a terrible idea. It's like me going out and buying a Hummer right now.
Wait, hold on. So are you for you to rent out to other people as a vacation home, or is this like, I've got an extra house in Florida that I go to like every month or something?
Well, what I was explaining was a second home that you go and hang out for 6 months.
I mean, if you got the money, you should do it. You know what I mean?
I think it's a terrible idea.
If your bank account looks like a Swedish bakery and you got all that dough, why not, man?
I think your money is better spent on actually growing a business, investing back into something that actually makes you money. Than
invest it with me.
So anyways, invest with this guy.
Right, I gotta get that in there. You know what I mean? So vacation rental. So I'll tell you this. So I own a vacation rental. I do, right? That I put on Airbnb and VRBO. Right. Shout out to Sam Saboti, my business partner. We've had this past Monday. So today is Thursday. Today's Thursday.
Today's Thursday. Yeah.
So on Monday alone we've had 3 cancellations, and I think since Tuesday we've had 2. So you're talking about this week we've had 5 cancellations. Of course, the fact that a round trip from Chicago to Florida, from Chicago to Orlando, a round trip is $31, I think speaks for itself. So I've personally had cancellations. I know a lot of my friends who do vacation rentals have lost a lot of money. So yes, I don't think it's a good time right now, but maybe 6 months down the road.
Yeah. Glenn is asking, still wise to flip homes for the next couple months? Will prices go down or stay the same for a while? I think for me, you're going to see a lot slower movement in terms of your flip. When you put it on the market, I think it'll take longer. The market time is going to increase, in my opinion. At least if we're going to